Hey everyone, and welcome back to The Explainer. Now, if you are a focused learner looking to take absolute control of your financial trajectory, well, you're exactly where you need to be. Today, we're completely transforming how we think about budgeting. I know, a lot of people hear the word budget and instantly think of restriction, being tied down or having to give up that daily cup of coffee. But what if we completely reframe that? We are going to look at budgeting not as some kind of financial straitjacket, but as a dynamic, highly strategic map to your ultimate life goals. We often have the sincerity and the determination to improve our lives. We really do. But the hard truth is that just isn't enough. Like the quote says, without a blueprint, we're basically just hoping for the best. A budget is literally the bridge between our castles in the air, all those big dreams and goals we have, in the facts on the ground, which is our actual day-to-day financial reality. So what is a budget, technically speaking? Well, it's a projection of the financial requirements and consequences of a plan. The key takeaway here is that it's absolutely not just a reflection of what you spent last month. No way. It's a dynamic document of action. Think of it this way. While your bank statements tell you where you've already been, your budget defines your next choices and tells you exactly where you're going. So here is our roadmap for today. We'll start with the infinite budget process, then build a comprehensive budget, master cash flow timing, learn how to course correct with variances, and finally, lock in your financial life strategy. Let's get to it. All right, diving right into section 1, the infinite budget process. So budgeting is definitely not something you sit down, do once a year on New Year's Day, and then just forget about. It's actually a continuous, infinite loop. I mean, your financial life doesn't stop, right? So neither should your plan. You don't just create a budget and walk away. Instead, you're constantly moving through these interconnected stages because, well, your life and the broader economy are always changing around you. Let's quickly walk through the logical flow of this loop. Step 1, you define your short and long-term goals and gather your historical financial data. Step 2, you form expectations by squaring those goals with your actual reality. Step 3, you finally create the budget itself. Step 4, and honestly this one is absolutely critical, you monitor the outcomes and analyze variances. Basically that means looking at the differences between what you planned and what actually happened. And finally, step 5, you adjust your expectations and budget, which seamlessly leads you right back to step 1. Now, as you feed data into that loop, you've got to employ what we call financial conservatism. And just to be clear, this has absolutely nothing to do with politics. In finance, conservatism is a literal superpower. It means you always overestimate your costs and underestimate your earnings. Why? Because it acts as a strategic shield. When you budget conservatively, the only financial surprises you'll ever encounter are the happy ones. Okay, now that we understand the loop, let's look at the anatomy of your plan in section 2, building your comprehensive budget. This is where we separate our short-term living from our long-term building. A comprehensive budget is actually made up of 2 halves. On the operating side, you have your short-term recurring incomes, like your wages, and your recurring expenses like groceries, gas, and electricity. Then on the capital side, you have your long-term, non-recurring items. We're talking big capital expenditures like buying a car or investing in a retirement fund. The whole goal here is to manage your operating budget so efficiently that it generates free cash flow to fuel your capital budget. To really make this concrete for us, let's introduce a case study. Meet Mark. Mark is a school counselor. He works hard, he tutors on the side, does house painting in the summer, and even trades sports memorabilia online. Now, Mark has a massive capital budget goal this year. He desperately needs a new roof, and it carries a really painful $15,000 price tag. But, importantly, he wants to avoid taking on bad, high-interest debt to get it done. So, Mark's ability to save for this roof is influenced by a few different factors. First, you have his personal micro-choices. For instance, he can choose to take on more tutoring clients, or maybe give up his annual vacation to save some extra cash. But he's also affected by macroeconomic factors that are completely out of his control, things like volatile spikes in gas prices or rising interest rates. His budget has to account for all his income streams, ranging from his steady year-round counseling wages to his highly seasonal summer painting cash. Which brings us to section 3, timing and the cash flow budget. Now this is really interesting. If we look at Mark's annual budget, he actually makes enough over the entire year to cover his expenses. But, as we all know, timing is everything. His income isn't perfectly steady. He gets a big payout from seasonal painting in July. But wait, his original plan was to pay for that $15,000 roof in May. Do you see the timing mismatch there? If he pays for the roof in May, he's out of cash months before his summer painting money even arrives. Because of that seasonal gap, If Mark stubbornly sticks to a May timeline for the roof, he's going to be completely drained. In fact, he will have to borrow exactly $10,525 on a line of credit just to survive the summer. He'd be taking on new liabilities and paying interest for 7 whole months of the year, all just because of bad timing. But the cash flow budget reveals a pretty brilliant remedy. Check this out. If Mark simply delays the roof project to October, his summer painting income will have already hit his bank account. Because of that one change, his peak borrowing plummets to just $5,730, and his total interest paid is nearly cut in half. Simply by shifting his timeline, he dramatically minimizes his debt and his risk. Moving on to Section 4, even with a great timeline, reality always brings surprises, which is why we need to talk about budget variances and course correction. Remember earlier when I said a budget is just a projection? Well, a variance occurs when your actual results differ from your expectations. Let's anchor this abstract idea to a very relatable pain point for all of us. Imagine you're following your budget perfectly. You calculated your monthly fuel costs based on your typical commute. Then suddenly, bam, macroeconomic factors shift, and the price of the gas pump skyrockets. So I have to ask you, what actually happens when this variance hits your operating budget? You've got a few choices, and honestly, none of them involve just ignoring it. Do you drive fewer miles to keep the total cost down? Do you spend less in another category, like entertainment, to balance the whole thing out? Or do you try to pick up extra hours at work to earn more income? The thing is, if you aren't monitoring your budget in real time, you won't even realize you need to make these choices until you're already in the red. Isolating the root cause of a variance is absolutely vital. First, ask yourself, is this a quantity change or a price change? Like, did your gas bill go up because you actually drove more miles or because the price per gallon surged? Next, is it a micro factor within your control, like choosing to work fewer hours, or a macro factor, like the economy slowing down? Analyzing variances this way identifies problems super rapidly and highlights your most realistic potential remedies. But hey, variances aren't always a bad thing. Let's check back in on Mark. He monitored his budget for the first quarter and actually found positive variances. He picked up some new tutoring clients, and the macro economy favored his side hustle, causing his sports memorabilia prices to surge. Because Mark was paying close attention, he realized he was generating much more free cash flow than he expected. He can now pay for the entire October roof project straight out of his money market savings account, completely eliminating the need for a line of credit. No debt whatsoever. And that brings us to our final section, Section 5, your financial life strategy. Connecting all these micro decisions back to his overarching life goals really comes down to understanding the trade-off between liquidity and opportunity cost. By diligently monitoring his operating budget, his variances, and his cash flow timing, Mark was able to use an asset, his cash savings, to finance a physical asset, which was his new roof. Yes, he dove up some liquidity and a tiny bit of interest income from his savings account. That's an opportunity cost. But he entirely avoided taking on a new liability. Remember, banks always charge more to lend you money than they pay you to save it. So avoiding that bad debt, that was a massive strategic win for his overall net worth. So, as you can see, budgeting is so much more than just tracking your daily expenses. It's the ultimate tool for navigating variables and protecting your life goals. Think about it. How you finance your life directly determines how you live your life. You've got the map, you know how to build the infinite loop, and you know how to course correct when surprises pop up. So I'm going to leave you with this one question to think about. What is your life strategy, and does your current budget actually reflect it? Thanks so much for joining me on this explainer, and I will see you next time as we continue to build our knowledge together.